America, the land of the free, the home of the brave, and a nation built on the principles of liberty and opportunity, has always had a complicated relationship with free trade. From the early days of its founding, the United States has grappled with the balance between protecting its own industries and engaging in the global marketplace. Enter President Trump, a man who views tariffs not as economic weapons of mass destruction, but as finely tuned instruments of negotiation. His approach to trade was unconventional, to say the least. Trump believed that by imposing tariffs, he could bring other nations to the negotiating table, forcing them to agree to terms more favorable to the United States. This strategy was evident in his dealings with China, Mexico, and the European Union. In 2025, his target was Japan, specifically their robust auto industry. Japan, known for its high-quality vehicles and efficient manufacturing processes, was a significant player in the global automotive market. Trump proposed a whopping 25% tariff on imported vehicles, a move that sent ripples through the industry. The announcement was met with mixed reactions, with some praising the move as a necessary step to protect American jobs, while others warned of the potential repercussions. A move seemingly designed to protect American manufacturing. The idea was to make imported cars more expensive, thereby encouraging consumers to buy American-made vehicles. This in turn would boost domestic production and create jobs. But was it a stroke of genius or a prelude to economic disaster? Economists and analysts were divided. Some believed that the tariffs would lead to a trade war, with countries retaliating with their own tariffs on American goods. The proposed tariffs sent shockwaves through the global economy. Stock markets reacted with volatility, and businesses on both sides of the Pacific braced for impact. The uncertainty was palpable, and the stakes were incredibly high. Japan, a country known for its composure, responded with a calm but firm resolve. Japanese officials held press conferences, reiterating their commitment to fair trade and their readiness to defend their economic interests. Their message was clear: this was not a game they were willing to lose. Japan's auto industry was a cornerstone of its economy, and they were prepared to take necessary measures to protect it. The stakes were high, and the world watched with bated breath. As the situation unfolded, it became clear that the outcome of this tariff battle would have far-reaching implications, not just for the United States and Japan, but for the entire global economy. Japan, however, wasn't just another trade war casualty. In the complex web of global finance, Japan held a unique position. While many countries were grappling with the implications of new tariffs and trade barriers, Japan had a strategic advantage that set it apart. They held a powerful card: $1.1 trillion in US debt. This wasn't just a number, it was a significant leverage point in international relations. The sheer volume of US Treasury bonds owned by Japan gave them a unique influence over the American economy. That's right, folks, Japan owns a significant chunk of America's IOUs. This financial interdependence meant that any drastic action by Japan could have far-reaching consequences. The bonds represented not just money, but a complex relationship of trust and mutual reliance. Their message was simple: impose these tariffs, and we might just start calling in our loans. This wasn't a mere bluff. The Japanese government was acutely aware of the potential impact of their actions, and used this knowledge to their advantage. This was not an idle threat. The Japanese officials were serious, and their resolve was evident in their stern expressions and calculated statements. They knew the stakes, and were prepared to act if necessary. If Japan decided to sell off its US Treasury bonds, it could trigger a domino effect, sending shockwaves through global financial markets. The interconnected nature of modern economies meant that such a move would not just affect the US, but could lead to a global financial crisis. Interest rates could skyrocket, borrowing costs would soar, and the American economy could plunge into chaos. The ripple effects would be felt by businesses and consumers alike, leading to a potential economic downturn that could take years to recover from. Suddenly, Trump's tariff plan didn't seem so brilliant. The potential repercussions of Japan's financial maneuvers highlighted the delicate balance of international trade and finance. It was a stark reminder that in the global economy, every action has a reaction, and sometimes the consequences can be far more significant than anticipated. The Japanese auto industry, a titan in its own right, prepared for the worst. Companies like Toyota, Honda, and Nissan, with massive manufacturing plants in the US employing thousands of American workers, faced a grim choice: absorb the tariffs and watch their profits dwindle, or pass the costs on to consumers, potentially crippling sales. The tariffs threatened not just Japanese companies, but the entire global supply chain. American automakers, reliant on parts from Japan, also faced uncertainty. The once roaring engine of the global auto industry sputtered, threatening to stall completely. Faced with mounting pressure from international allies, economic experts, and even members of his own party, President Trump found himself in a precarious position. The proposed tariffs, which had been a cornerstone of his aggressive trade policy, were now under intense scrutiny. President Trump did something unexpected. He blinked. In a rare moment of concession, he decided to put the tariffs on hold. This decision came as a shock to many who had grown accustomed to his hardline stance. The proposed tariffs were shelved, at least for the time being. This move was seen as a temporary respite in the escalating trade tensions. It was a strategic retreat, aimed at buying time and possibly renegotiating terms. It was a stunning reversal, a clear victory for Japan. The Japanese government had lobbied hard against the tariffs, arguing that they would harm both economies. Their persistence paid off, showcasing the importance of diplomatic pressure, and a testament to the power of economic leverage. Japan's ability to influence this decision highlighted the interconnected nature of global economies. It was a reminder that no country operates in isolation. The concession, however, came with a cost. It exposed the vulnerabilities in Trump's trade strategy. Critics argued that the tariffs were a blunt instrument, ill-suited for the complexities of modern global trade. It exposed the limits of Trump's aggressive trade tactics. The decision to back down was seen by some as an admission that the strategy was not working as intended. It raised questions about the administration's ability to navigate the intricate web of international trade relations, and raised questions about America's commitment to global economic stability. The markets reacted with a mix of relief and uncertainty. Investors were glad to see a potential trade war averted, but they remained wary of future policy shifts. The world had witnessed a high-stakes game of chicken, with both sides pushing each other to the brink. The stakes were incredibly high, with billions of dollars and countless jobs hanging in the balance. And for once, Trump had swerved. This moment marked a significant shift in the administration's approach to trade policy. It was a moment of humility, a recognition that sometimes even the most powerful must yield to the realities of global diplomacy. The tariff threat, though averted, left its mark on the global economy. The International Monetary Fund warned of potential damage, highlighting the interconnectedness of global trade. Central banks around the world nervously adjusted their monetary policies, bracing for the aftershocks. The episode served as a stark reminder of the fragility of the global economic system. It exposed the dangers of protectionist policies and the potential for economic conflicts to escalate quickly. The world breathed a collective sigh of relief, but the experience left a lingering sense of unease. Within the United States, the economic outlook remained uncertain. The tariffs, had they been implemented, could have triggered inflation, making everyday goods more expensive for American consumers. Slower economic growth, coupled with rising prices, painted a bleak picture of stagflation. The tariff saga also raised questions about America's role in the global economy. Was the U.S. retreating from its traditional position as a champion of free trade? The answer, it seemed, was far from clear. The American public, as always, was divided. Some applauded Trump's tough stance on trade, praised his willingness to stand up for American workers and industries. Others expressed concern about the economic fallout, fearing job losses and higher prices. The tariff debate highlighted deep divisions within American society, reflecting anxieties about globalization and the future of the U.S. economy. It was a debate that was far from over. The averted trade war between the U.S. and Japan raised fundamental questions about the future of international trade. Would countries retreat into protectionism, erecting barriers and jeopardizing global economic growth? Or would they find ways to cooperate and maintain open markets? The answers to these questions will shape the global economy for years to come. The stakes are high, and the world is watching closely. The trade tensions of 2025 served as a wake-up call. The global economy, while resilient, is not immune to the actions of individual nations. The US, once a beacon of free trade, seems to be charting a new, more unpredictable course. The world is adapting to this new reality, a reality where economic power is shifting and the rules of the game are constantly evolving. Buckle up, folks, it's going to be a bumpy ride.